Alright guys, welcome back to the channel. Today I want to share my latest research on dividend investing and whether or not it's worth it. To be more specific, I want to find out exactly what the contribution of a dividend is to the overall return of a stock. In addition, we can refine that down further, separating high yield dividend growth companies, see if there's any major difference between the two. And then ultimately, I want to give you guys my take on how I currently implement dividends within my greater strategy. And let's begin with this chart. I find this super fascinating as it shows the return of the S&P 500 dating back to 1960 and split between just the price and having the dividends reinvested. And as you can see, there is an absolutely ludicrous difference between the two. And the S&P 500 over this time period only has a yield of between 1.5% and 2%. And it still makes an absolutely massive impact on the final total returns. So on point one, yes, unequivocally, dividends do matter and represent a meaningful part of a stock's return. Now, where I think people go wrong with this is when they take it to the extreme. They conclude that because the dividend is a meaningful part of the return, the higher the dividend, the better the stock. And in particular, when you begin to look at high-yielding stocks, the landscape is full of these mature, slow-growing companies like AT&T, Verizon, Coca-Cola, Kimberly-Clark. Often these are high-quality, cash flow generative companies, but the reality is Coca-Cola is just never going to grow at 20% per year. So instead, to help attract investors, they pay out a large dividend. But for the investor, that dividend cannot make up the difference usually between them and a faster growing business that has good reinvestment opportunities. In particular, let's take a look at Kimberly-Clark and Apple. As you guys might know, these are both dividend paying companies. Apple is a classic dividend growth company, and Kimberly-Clark, a high yield, older, more mature company with limited growth opportunities aside from mergers and acquisitions. And as we can see here, of course, Apple is the much better option for an investor. And when people claim that dividend investing doesn't work, it doesn't have competitive returns, they're referring to these companies, Kimberly-Clark, Coca-Cola. It's a big misconception that tech is always going to give you the best returns. They look at the 5-year chart, they stack QQQ against the market, dividend names, and they conclude that tech is the way to go. However, this is seriously flawed. It's recency bias because if you just zoom out far enough, you can see that tech doesn't give you better returns. So the QQQ dating back to the year 2000 has an annual rate of return of 6.38%, and the market 6.48%, with a lot less volatility along the way. And speaking of volatility, this brings me to the next major positive of dividends, which is the effects it has on reducing volatility. So we've all probably seen charts like this before that indicate the average investor severely underperforms the rest of the market. And you guessed it, this is from market volatility. If the market had returns like this, steady, up and to the right, everybody would make the same profit. Now this chart shows the effect of missing just the 10 best days in the market over a time period of 2 decades. So if you were fully invested over this time, your $10,000 initial investment would have grown to $64,000. But if you miss just the 10 best days in the market over this entire time, your total returns are cut more than in half. The single best day in the market was October 13th, 2008, where the market went up 11.6% in just that one day. The next best day was 10.8% in October 2008. And then 9.4% in March 2020. You're probably noticing that all of these best days in the market are during extreme volatility, the '08 market crash and the sell-off in 2020. It seems like the best and worst days in the market happen right next to each other. So October 9th, 2008 was one of the worst days in the market, down 7.62%. And then just a couple days later, October 13th, the market was up that massive 11.56%. And this extreme volatility is what shakes people out of their position, and it's why the average investor so severely underperforms. And here's where dividends can help to smoothen out the volatility. So this chart shows the dividend contribution to total return for each decade. When there's not a lot of volatility, like in the 2010s, the 1990s, the dividend, it's still meaningful, but it's only 16, 17% of the total return. But when there's more volatility, like in the 2000s, the 1970s, the dividend accounts for a much larger portion of the total returns, and it goes a long way in helping to smoothen out this volatility. And if that can help you to stay invested and realize some of these best days in the market, that's going to have an outsized impact on your total returns. Now, before showing you guys how I currently implement dividends within my portfolio, let's quickly recap what we learned. So dividends do have a direct noticeable impact on total returns, but a higher dividend does not equal better returns. This right here is the total returns of VYM against that of the market, and high yielding companies returned 7.48%, while the market returned nearly 9%. In contrast to that, quality dividend growth companies over a slightly different time frame returned 12%, and the market during that same time frame 11.87%, slightly outperforming the general market. So that means over the long term, these quality dividend growth companies can even outperform non-dividend paying tech companies like the QQQ. And they do that with less volatility. The dividend is way more consistent than the price action, which could help you to stay invested and realize some of the best days in the market, which have an outsized impact on your final total returns. So with that said, this is the current makeup of my portfolio. The core of it consists of these two names right here, ticker QGROW and Divo. The thing I love about both these funds is they focus on quality grown companies with strong fundamentals. They go about it in a slightly different manner, different methodology, but because they focus on similarly high quality companies, there's a good amount of overlap between their top holdings. So for QGROW, the top 10 holdings include Apple, Microsoft, Google, Nvidia, Amazon, Tesla, Meta, United Health Group, Visa, and MasterCard. And for Divo, the top 10 holdings have overlap including United Health Group, Visa, Microsoft, and Apple. Where they differ is Divo has an active, partial covered call writing strategy to help you realize gains along the way. It does slightly limit your upside participation, but it helps to smoothen out volatility, and QGROW has no such limitations. It's a lot more volatile, but still invest in similar high quality, strong companies. And I just think these two ETFs work extremely well together. And if you want a high yield, personally, my opinion right now is Divo. This strategy is better than something like Verizon, AT&T, or Coca-Cola. And then my other ETFs include XYLG and IXN. And these are essentially fallbacks for the aforementioned funds in case they underperform or the active management of Divo doesn't do so well. XYLG can take its place, it's systematic, and same thing with IXN, it's a global, diversified tech ETF. So that's a look at my portfolio. I hope you guys enjoyed the video, and I'll see you guys in the next one.